Welcome to The Explainer. Today we're diving into one of the wildest contradictions happening in the global economy right now. We're going to untangle the conflicting narratives around the massive shift from internal combustion engines over to electric vehicles. It's a monumental industry shift, right? It's been quietly building momentum since around 2010, but right now it is literally hitting a boiling point. Let's get right into it.
Okay, let's kick things off with a massive number, 17 million. That's the record-breaking number of global electric cars sold in 2024. To really wrap our heads around the scale here, we gotta look in the rearview mirror for a second. Think back to 2010. Global EV sales were barely a blip. We're talking just a few thousand early adopters scattered worldwide. Fast forward to 2020, and sales hit about 3 million. Now get this, just the additional 3.5 million EVs sold in 2024 alone is actually more than the entire global volume of electric cars sold just 4 years prior. Looking at this seemingly unstoppable 14-year run, you probably assume the road to an all-electric future is wide open and totally clear, wouldn't you?
Well, here's where we hit a massive paradox. A recent EY report just dropped a stunning shift in consumer sentiment. Half of the world's car buyers, 50%, now actually plan to return to internal combustion engine vehicles, or ICE vehicles, in the next 2 years. That purchase intent is actually up by 13 percentage points, while the intent to buy a pure EV, that dropped by 10 points. So what exactly is going on here? Why are these record-breaking multi-million unit sales suddenly colliding head-on with this massive consumer pushback?
That brings us to part one, the regional divide. To figure out this paradox, we've got to look at the stark contrast in regional adoption. See, the global market isn't just acting as one big cohesive unit. It's really a tale of two completely different realities. If we compare the data for China versus the United States, you can clearly see how the EV price premium lines behave. In China's market, those lines are literally diving below zero across a bunch of vehicle segments. What that means is EVs have hit price parity, or they're actually cheaper than gas cars, which lets them absolutely dominate sales. A huge reason for this? China has incredible dominance over the whole battery supply chain, which drastically lowers their production costs. Meanwhile, looking over at the US market, those price premiums are staying stubbornly high. It reflects those lingering manufacturing costs, a huge reliance on external supply chains, and frankly, a much slower pace of consumer adoption.
Let's break down those market realities a bit further. Thanks to that massive cost advantage, in China, 1 in every 10 cars on the road is now fully electric. Plus, they're manufacturing over 70% of the entire world's EV supply, mostly just to satisfy their own massive domestic audience. But then, look at the West. Europe's EV sales have largely stagnated as their supportive government subsidy schemes kind of fizzle out. And the US? They saw a pretty modest 10% year-over-year growth. The big takeaway for you here is that the global transition isn't actually stalling, it's just moving at completely different speeds, depending on the specific economic and manufacturing realities of each region.
Which leads us perfectly into part two, the root cause, the price parity puzzle.
This brings us directly to the core issue driving this whole global disconnect. It's the sheer cost of the vehicles themselves. Take a look at how available EV models are distributed by price across China, Europe, and the US in 2024. Notice how heavily skewed things are on the higher end for Europe and the US? Western markets are practically flooded with expensive electric models priced well over $40,000. But then, look over at China. They have a massive array of electric vehicles priced under $25,000. Actually, about 40% of their available electric models sit below that crucial $25K mark. That is a real game changer.
The absolutely crucial point here is that true mass adoption relies entirely on affordability, period. The data tells us that 2/3 of all electric cars sold in China in 2024 were cheaper than their gas-powered equivalents. China hit true mass market appeal by just driving down costs across the board. Meanwhile, Western automakers are still relying really heavily on high-margin, expensive luxury SUVs just to offset their higher production expenses when the median price paid for a battery EV in China is sitting around $24,000, but the West is still completely skewed toward the luxury segment. Well, that global gap in adoption really starts to make perfect sense, doesn't it?
So moving on to part three, consumers' pushback.
This severe lack of affordable, everyday options in the West leads us directly into why consumers are currently hitting the brakes and actively reconsidering traditional gas cars. The EY report data spells out exactly why buyers are hesitating. It's a mix of things, really. You've got shifting government policies and the rollback of tax incentives that used to make these pricey cars, a bit more palatable. Throw in intense price pressures in a generally tough economy, uneven and unreliable charging infrastructure, and of course, stubbornly persistent range anxiety. And let's be real, that fear of running out of battery before finding a working charger is still very, very real for people. In fact, 36% of potential EV buyers are actively delaying their purchases right now. They're weighing all these complex variables and treating these infrastructure gaps not just as minor inconveniences, but as massive roadblocks.
And you can see how this sentiment is shifting back to legacy gas engines across basically all major markets in response to those economic realities. We're seeing an increased intent to buy ICE vehicles literally everywhere, up 12 percentage points in the Americas, 11 points in Europe, and 10 points in the Asia-Pacific region. So this isn't just some isolated incident or a weird little blip in the data. It's a widespread global reaction from consumers who simply feel like the supporting ecosystem isn't ready or affordable enough for their daily lives quite yet.
Let's look ahead to Part 4, the road to 2040.
Okay, so despite this current consumer resistance, and even with major legacy automakers openly scaling back their immediate electric targets to meet that ICE demand, we really need to zoom out and look at the long-term mathematical forecast. Sure, internal combustion engines are expected to hold the largest share of the global mix through 2025. But if you look at the timeline here, it clearly charts an undeniable convergence toward global electric dominance. According to Automotive 24, global EV market share is forecast to hit 27.5% by 2026, and then it just accelerates dramatically. We're talking 43.2% by 2030, nearly 65% by 2035, and an overwhelming 83.2% global share by 2040. So yeah, the short-term bumps in the consumer pushback are very real right now. But if you map the entire trajectory since 2010, the long-term transition toward electrification is definitely firmly set in motion.
Which brings us to the ultimate question we want to leave you pondering today. As global forecasts project a massive 83% EV market share by 2040, will affordable price parity and reliable charging infrastructure actually catch up before consumer patience completely runs out? It's a completely fascinating global transition, right? It's just full of these massive technological leaps, but also some pretty frustrating economic paradoxes. Thank you so much for joining me on this explainer. Definitely keep this data in mind the next time you're out on the road, and I will catch you next time.